I'm Olivia Albrecht, and I'm joined by my colleague, Joachim Fels. We're here to discuss our outlook for the global economy. Thank you, Joachim, for joining me today. What are we thinking, and what's changed for our outlook in the year ahead?
So if I think about our secular framework, stable but not secure, that's pretty much what is playing out at the moment. The global economy and markets look stable on the surface. And we've actually upgraded our forecasts a little bit. But at the same time, we do worry about some of the longer-term risks that are lingering in the background and that are gradually building. First of all, the rising debt levels around the world. Second, the diminishing returns to expansionary monetary policies. And then the third risk we've been worrying about for some time is the rise of populism and nationalist policies. So I think the secular framework has served us well. Now, when I think about our cyclical framework and our cyclical outlook, we were talking about fatter tails of the distribution of outcomes. I think that's still very much the case. Fatter right tail, fatter left tail risks, because we have very little certainty yet about the Trump administration's economic policies. There are risks surrounding the elections in Europe this year. And thirdly, in China, China is facing a very tricky transition and very tricky policy choices. So I would say our framework is still intact. We're still talking about fatter tails to the outlook. But maybe the right tail and the left tail risks have become a little bit less fat over the last 3 months.
So the stable but not secure framework still persists, similar with our fatter distributions for the right and left tail scenarios for the cyclical outlook. How does that translate into our global GDP and inflation forecasts? What are the big changes that we see on the horizon?
Well, Olivia, we haven't made big changes, but we have upgraded our global forecast. So for world GDP growth, we're now looking for 3% growth this year. This is about a quarter point higher than what we thought in December. And it would mean that growth this year is about half a point above the realized growth rate of 2016. Basically, 3 reasons for that. First of all, we've had an easing of financial conditions because equity markets are up.
Yes.
Bond yields have remained relatively low since December. And the dollar has remained relatively stable. Second reason is animal spirits are kicking in. We can see that in business confidence and in consumer confidence data. And this is not only a story for the US, but also elsewhere in the world. And then thirdly, there has been a quite surprising rebound in global trade over the past 6 months. And so this is kind of lifting all the boats. Now, in terms of the regional composition, the biggest upgrades we've had in the UK and in the Eurozone this year, where we've entered the new year with a lot of momentum. We've also somewhat upgraded our forecasts for the economies in emerging markets that were in recession last year. So Brazil and Russia are now re-emerging from recession, quite moderate growth rates, but it looks a little bit better. And then in terms of what's unchanged, well, our numbers for China and Japan have not changed. And also in the US, we still feel very comfortable with our forecast of 2 to 2.5% GDP growth and 2 to 2.5% CPI inflation. So easy to remember, both in the 2 to 2.5% range. And as I mentioned, business confidence, consumer confidence is up. So we think we can see a continuation of above trend growth in the US this year.
Excellent. So modestly brighter outlook for the year ahead. The theme that we discussed at our forum in March was scaling it back. You identified 3 or 4 key swing factors that we discussed at great length in the forum process. They were Trumponomics, the policy agenda for Trump, European political risk, China, and scaling it back in terms of central banks looking for the exit. So tying this all together, you've painted a modestly brighter outlook for the global economy in the year ahead, and the key swing factors that we're looking at seem to be kind of scaled down in terms of the risk factors.